If you only have a little bit of money, how do you invest in real estate? I'll tell you and even pinpoint exactly how much you need to start. Then, for decades, people have been giving you terribly wrong advice on something that's going to be vital to your finances for the rest of your life. I mean, what's happened here is even inexcusable. I'm going to clear that up today. It's something that you've never seen before. So settle in and watch this video until the end, because you'll learn new things that really affect your future with 3 listener questions and answers. Hi, I'm Keith Weinhold, Get Rich Education founder and Forbes Real Estate Council member. The first listener question comes from Jeanette in Seaford, Delaware, asking, I only have a little money to invest in real estate. What is the best way to get started? First, talk to a lender. You have to consult with a mortgage specialist or loan officer to find out just what you qualify for. You're basically trying to get them to punch holes in your financial picture, and then you'll know what holes to go patch. So your loan officer is essentially giving you a free counseling session. You don't have to pay an advisor. Now, what are some holes that a mortgage lender might poke in your finances, Jeanette? Well, getting your credit score up, and they'll help you with that strategy. Or say you simply need more dollars in savings, or you need to establish a 2-year job history, or you have to pay off your car loan in order to get your debt to income ratio lower. Whatever it is, your goal here is to get a pre-approval letter so that you can then go make an offer on property. How much money do you really need? Now, I'll give you some even lower cost options shortly, but first, since at GRE Marketplace, the least expensive already renovated turnkey income property is about $120K right now. Well, you'll need 23 to 25% of that, because you need 20% down plus 3 to 5% in closing costs. So then 28 to 30K is the minimum lump of cash that you'll need. That's to buy a property that's in pristine condition, already fixed up and ready for a tenant. That's option 1, the turnkey model. And see, this is a great way to start in real estate investing if you want to maintain your standard of living. You'll have privacy, as you won't be living on the same site as your tenants. But if you're willing to temporarily let your quality of life slide for a couple years, you can put as little as 3% down on a primary residence and then rent out the other rooms. This is option 2, the house hacking model. Now, depending on your setup, maybe you're sharing a kitchen with roommates or suite mates, hence that temporarily loss in your quality of life. Maybe you can even Airbnb the house hack, a short-term rental, in which case you'll also be buying furniture. You can increase your income this way, but you'll definitely increase your management and turnover hassle with short-term rentals. Now, with 3% down on an owner-occupied house hack like this, you're probably going to have to pay a PMI premium of a few $100s per month, mortgage insurance, but still, this gets you in with very little money. 3% down plus, say, 4% closing costs on a $300K starter home is $21K. And finally, there's option 3. This is where you can get a combination of both maintaining your standard of living and putting a small down payment on property. That is by using an FHA loan and a 3.5% down payment, and you can do this with either a single family home, duplex, triplex, or fourplex, living in one unit and renting out the others. So yes, you get both this way, a low down payment and your own unit walled off from your tenant. Now, with the FHA loan for a single family home up to a fourplex, you've got to reside in one of the units yourself for at least 12 months, and you need a minimum credit score of just 580 to get that 3.5% down FHA loan, but a higher credit score will get you a lower mortgage rate. And you might already know that this is how I started out, with an FHA loan on a fourplex, because I didn't have a lot of money when I started. I lived in one unit and rented out the other 3. And Jeanette, you can watch this fourplex video where I tell you exactly how I did that. Two quick helpful resources. Our investment coaches here at GRE give a free consultation to help you with some of these decisions for option one, the 20% down on a turnkey property. But we don't originate loans, so you want to get with someone like our good friends at Ridge Lending Group to help you know what you qualify for. They are an investor-centric lender, and the consult with them is free as well. The next question comes from Jared in Pocatello, Idaho. After Jared's question, I'll address the inexcusably bad and just terrible guidance that everyone's gotten wrong for decades, steered you in the wrong direction, and I'm going to clear it up for you. But first, Jared asks, Keith, in the past year, my duplex in Pocatello went up in value 5% from $400K to $420K. How do I know how much of that 5% is true appreciation and what portion of the 5% is from inflation? Oh, that's such a devastatingly cool question, Jared. That's exactly what I thought when I saw that come in. Basically, Jared is asking, say in the 5% price change, is 3% from appreciation and 2% from inflation, or is it 4 and 1, or what's the breakout of those two? A lot of people don't understand the difference and even know enough to ask a question this good, so props there, Jared. One thing you cannot do is just look at CPI inflation over the last year for the US, which is, say, 2.9%, and then figure, oh, well, then I guess the other 2.1% is appreciation. No, there's more to it than that, because consumer price inflation is a different phenomenon than asset price inflation and a lot of other reasons. Appreciation, though, is distinctly different from inflation because the value of your property increasing 5%, that has to do with the attractiveness of your property to the marketplace. These are attributes like high-paying jobs and proximity to those, and proximity to highways and shopping and desirable schools. Basically, all those axiomatic location, location, location qualities. And now I'm going to assume that you did not make an improvement or a renovation to the property, Jared, because obviously that would hike up the value. Now, other appreciation attributes that are distinctly different from inflation are population growth and wage growth in an area. And before I tell you what can really pump up your property appreciation and that terrible guidance that experts have given for decades, hey, you can always write in with your question at getricheducation.com/contact. Oh, go ahead and put a like on the video here. You don't have to, but if you like how I'm breaking it down, I would really appreciate the like. I write a regular real estate investing newsletter with great timely info that you can get free by texting GRE to 66866. I'll keep that on screen for you here. What can really pump up your appreciation is if the remaining availability of developable land starts shrinking in a desirable location. That introduces market scarcity. Now, contrary to popular belief, mortgage rates have little to do with appreciation. And now, how appreciation is different from inflation is that inflation is not about the intrinsic value. Rather, inflation is the price of the home increasing only because the currency is worth less. Now, I hope you found that explanation satisfying, Jared, but what's dissatisfying is that it's actually hard to pin down a number. Like to say that it's 2.5% appreciation and 2.5% inflation or any other combination. It's hard to do that, and that's because inflation is practically impossible to accurately measure, and a lot of that has to do with an inflationary basket of goods is exceedingly difficult to adjust for attributes like changes to its quality and its utility, and the substitution of another item. So, Jared, it is likely that your duplex's 5% value increase is an amalgamation of both appreciation and inflation. That I can confirm, but the exact breakdown for each is virtually incalculable. Super insightful question there, Jared. The third and final of our 3 listener questions today is from Jeter in Roseville, California. And all right, this is the topic where all prior guidance is just terrible, inexcusably bad. Jeter asks, Keith, I am a true believer in get-rich education principles. I'm looking to pounce on some property this year and get leverage and other people's money working for me instead of only getting my money to work for me in my company's 401k. With mortgage rates being what they are today, I'd love to know what you think about where interest rates are headed next and what is going to make rates move. Thanks, Jeter. All right, well, I've got to tell you, Jeter, and I guess that's your first name, not only do I avoid predicting future interest rates, but I don't know of anyone in the world that can predict rates with high reliability. And here we go. Look at this graphic. The bold blue line is the actual Fed interest rate over time, and little purple lines are all of the prominent predictions of where experts thought rates would go. I mean, have you ever seen anything like this before? I've never seen a chart quite like this. I mean, it shows just how bad, really awful interest rate predictions have been over the last quarter century. And this really affects you because an interest rate, that is your cost of money. And this chart, it almost looked like a centipede. The blue line is the centipede's body, and all the hundreds of legs coming off are the dreadful, just god-awful, misleading predictions that experts have made. I mean, this track record is more abysmal than everyone saying we'd surely have a man on Mars by now. I mean, it is terrible. When you look at interest rate predictions, you are looking at a waste of your time. A year ago, the collective brain trusts of all the economic wizards believed with alacrity that mortgage rates would be sub 6% now. So in the fives, well, instead, they're still way over that today. And that might correspond with a 3 or 3.5% Fed funds rate. They're way over that today as well. And what's hilarious is that in more recent years, the Fed even tells us what they plan to do next. Yeah, Jerome Powell even tells us after the Fed meetings. I mean, this is a little like having the answers to the test and still failing. You've got the cheat sheet and you still aren't doing any better. Sheesh, how can this be? The reason that I don't make interest rate predictions is because it is a surefire way to look foolish. Now, I do forecast housing prices. If you want to know how much I expect home prices to rise this year to the exact percent, you can see that right here. To answer the second part of your question, what moves interest rates around? The answer is broad economic and political forces, and that's why it's so hard to predict. This includes jobs reports, supply and demand of credit, inflation, a pandemic, a surprise new war in the Middle East, tariffs, GDP reports, election outcomes, a massive change in tax policy, and more, like total entropy, okay? But there are some correlations that you can look at. For example, one thing that we know is that persistently higher inflation will soon result in higher interest rates of all types, just like we saw in 2022. Rates rise when the economy is bullish, robust, and optimistic. Conversely, rates fall when there's fear. In fact, that's why when you look at a rate chart, you see rates plunge like a cliff diver during the 2001 dot-com recession, 2008 global financial crisis, and 2020 COVID pandemic. And the reason that rates fall during fearful times is because the economy needs the help. And a little pro tip here, when a recession begins, expect rates to fall. But see, it can still be hard to predict the recession. We came off 3 Fed interest rate cuts late last year. That was a little weird because the economy doesn't need the help. It's sort of like offering Gatorade in a towel to someone that's not sweating. When interest rates scraped the ocean bottom floor at zero from 2009 to 2016, and then again from 2020 to 2022, That's unhealthy. See, natural market forces would mean that there is a cost to receive a service, like borrowing money. And with rates at zero, well, gosh, it feels like no one wants to save because you wouldn't get paid any interest on deposits, and yet everyone wants to borrow and spend. I mean, it is time to all out, ball out, because you can borrow for next to nothing. My two-time podcast guest and super smart guy, Dr. Chris Martenson, he thinks that rates are generally going higher from here, but otherwise guys say that they're going lower. And another embarrassing example of how many people make terrible rate predictions is that, for example, at the last Fed meeting last year, they disappointed markets by signaling plans to only cut rates twice this year instead of the 4 that were previously expected. And now even that has changed, and a lot of people question if those 2 cuts will happen this year at all, given things like a hot jobs report that came flying in and still too high inflation. I mean, this was kind of like expecting a rich, decadent dessert, and instead just getting one pathetic little Biscoff cookie. So Jeter, that's why I don't forecast rates, and I don't think anyone can. But now you know what moves rates around and about a few correlations. And I've got a couple resources for you. If you want a fun, real-time pulse on the market, check out Polymarket. You might have heard of it by now. That's a site where you can place bets on various outcomes, a lot of non-sports bets. You can see people put their money where their mouth is. There are wagers on Fed interest rate decisions at Polymarket. You can even bet on if Jerome Powell says good afternoon at his next press conference on Polymarket. I'm not kidding, and right now the odds of that are in the high 90s%. Remember this, the market has always felt confident about where rates are headed, and the market has always been wrong. Interest rates don't drive property values. Most people think they do. Most people think higher mortgage rates also mean lower home prices, but that's not true at all. Just look at history. It happened again back in 2022. Both rates and real estate prices spiked higher at the same time. Real estate's intrinsic worth, that is based on the timeless stuff, location, amenities, incomes in an area, occupancy, size, density, its business case, exit options, and operating costs. If you really want to read about where rates are headed, James Grant, based in New York City, he's a well-regarded resource. He puts out a publication called Grant's Interest Rate Observer that might give you a little better than 50-50 shot of where they're headed next. But as you can see, I wouldn't put too much credence in any interest rate predictor anywhere. The bottom line here is that no one knows the future. Interest rates direction is a pinball game of black swans and policy pivots. So instead, focus on the big things that you can control, like how many dollars you have leveraging properties and keeping your operations on those properties efficient. So waiting to own more income property, that generally harms an investor more than it helps them, because it's dollars on the sidelines that are paying the opportunity cost of not leveraging other people's money. And of course, if you buy your property at whatever interest rate and rates soon fall like a knife, then you can go ahead and refinance at the lower rate, all while leverage keeps compounding and building your wealth. Now, if I could start all over again in real estate, how would I do it? I'll show you. This can really help you. Watch me bear it all in this video right here.